there are several different types of purchase transactions we can look through. So let's walk through some examples of several of these. So you need merchandise, you're running low, you don't have any, you need some extra, whatever it is, you need to buy some more inventory. So when you make a general purchase, okay, you'll have an invoice, we can talk about purchase orders, all those things. You can look through those details, but when we buy that item or items, you're going to increase your inventory account. You're buying more, you're getting more inventory. So we take that inventory account, which is an asset, and we're going to increase it. And to increase assets, we would debit them. So the inventory, let's say we bought, I don't know, $10,000 in inventory. So we increase or debit that account for $10,000. Let's say that was on account. We haven't paid for it yet. So we're going to credit accounts payable. It's a liability. We're increasing it for $10,000. So there's the purchase. Now, remember, with freight involved, there's two types of shipping terms. We could have FOB shipping point or we could have FOB destination. But if it's FOB shipping point, that's one where the buyer is responsible for the shipping charges. So the seller could pay for us as a convenience, or we could pay. Okay, so either way, if it's not included in this that we've just done, if it wasn't included in this charge, then we need to record the freight. So that will also increase our inventory costs, because now it didn't really just cost me $10,000 because I had to pay to get it to me. So let's say that was an additional, I don't know, $500 in shipping charges. So we're going to also increase inventory for the $500 to get it to us. It's part of the cost of the purchase. And then we credit accounts payable or cash if we were paying for it. Or again, if the seller paid it as a convenience, we're still going to have to pay them back for it. So we'll still owe them that $500. So we're going to increase that accounts payable by $500. Okay, and that can take care of the freight. Now, if it's FOB destination, we're not responsible for the freight, so we don't even have to worry about it. That's the seller's responsibility, so we don't record anything in that instance. Another thing that we could have is a return, or returns and allowances. So let's say we get some of the merchandise or something's defective, we need to make a return. You can do that as well. If you make a return, you're physically, literally, giving inventory back. So you need to decrease that account. It's leaving, you're sending it back. And we don't use a returns and allowances account because that's something you do if you were doing periodic. And for this chapter, we focus on the perpetual system. So we're going to adjust the inventory account instead of hold that amount in returns and allowances. But if you return it to the company and it was on account, let's say, some of this $10,000 we returned, well, we owed them the money. If you haven't paid them yet, that's just going to go against your accounts payable to show that you don't owe them that because you're returning it. If you paid cash or you had already paid for this, then if they're going to just give you a credit, you'd still use accounts payable. But if not, if they return you cash, then you use the cash account. So let's put up here, this is going to be accounts payable or cash, depending on the situation. And let's say you returned $1,000 worth of inventory. You're also going to decrease your inventory account by that $1,000 because you don't have it anymore. You sent it back. Okay. One other item, discounts. Okay. In the terms of your purchase, you would have been given some credit terms also if they extend any. And so you might have seen something like, let's write up here, 210 in 30. These credit terms would mean that you will get a 2% discount if you pay within 10 days. Otherwise, you're to pay the net amount in 30 days. Okay, sometimes you'll see things like net EOM. That stands for net at the end of the month. So this tells me what a percentage discount I might get if I pay within this amount of time. Otherwise, I'm going to pay everything in 30 days. It's going to be expected to be paid. So let's say that we had something and it was 210 net 30. So I'm going to get a 2% discount if I pay within 10 days of that invoice date. Let's say I do pay within the 10 days. And so now I'm getting ready to pay before that time frame has gone out. So I'm going to get a little bit of a discount. Let's say it was just $100. Keep it nice and easy. So the total of our invoice was $100. All right, and I'm getting ready to pay it, and it was on account. So I'm not going to owe that $100 anymore. So I need to get rid of that accounts payable. So I'm going to decrease it. I'm going to debit it for the full invoice amount of $100, because right now it shows that I owe $100, but I'm not going to anymore. Okay, but am I going to pay $100? Remember, I'm paying within 10 days, so I'm going to get a discount. So the amount of cash that I'm going to pay is not $100. How much am I actually going to pay? I'm going to actually pay $98. So put cash up here, credit it, or decrease it for $98. What's the $2 represent? Well, that's the discount we got. We got a 2% discount. 2% of our outstanding invoice there was $100. Now be careful. If for some reason that $100 included freight charges that the seller paid on your behalf, you don't get to take a discount off of that. But let's assume this is just the amount of the goods that we purchased. So that $2 needs to go somewhere. And if we're under a perpetual system, we need to decrease inventory for that, because right now our records show that that inventory cost me $100. It didn't. It only cost me $98. So we need to decrease the inventory account to reflect that. So now after we post this entry, it'll show that our inventory is really at $98, not $100.